Joseph is sitting at a red light, staring at a mortgage calculator on his phone. He punches in the numbers for a house and waits. The monthly payment that pops up is $850 higher than the exact same house would have cost him just a few years ago. Same square footage, same zip code, same credit score, and same salary. Nothing about the house changed, and nothing about Joseph's income changed. When your mortgage quote goes up, you probably picture a board of serious people in a wood-paneled room in Washington, turning a giant dial labeled Your Monthly Payment. You blame the Federal Reserve. But the Fed actually controls a completely different interest rate. The number that decides your mortgage lives in an entirely separate, invisible global market, a machine that quietly reached into Joseph's life and added a second car payment to his budget. To understand your money, you have to understand this machine. It has three parts: a solid concrete foundation, a toll booth, and weather swirling around it. This system dictates your house, your car loan, and every credit card in the country. Once you see how these three specific parts move, you stop waiting for the Federal Reserve to save you, and you can finally track what is actually happening to your paycheck. This vintage U.S. savings bond shows exactly what a bond is, an IOU. When the government borrows money, it hands you a piece of paper that says, "Give me your cash today, and I'll pay you back later with extra interest." That interest rate is the foundation of our machine. In finance, they call it the 10-year Treasury yield. And even though the government issues the bond, they don't actually decide that rate. The rate is set by the people lending the money: global investors, pension funds, and foreign countries. When these lenders trust the government they play. When they get nervous about spending, they demand a higher interest rate to hand over their cash. Banks use this specific 10-year government bond as the baseline for pricing your home loan. They do this because the average homeowner moves or refinances within a decade, making the 10-year bond the perfect yardstick for a 30-year mortgage. This means whenever the global market doubts the U.S. government's financial habits, the foundational cost of your mortgage automatically goes up. Next, we have the toll booth. This is the extra markup Bouse charge to turn that safe government bond into a loan for a regular person. Investors charge this toll because regular people have a superpower Wall Street hates. If rates fall, you can refinance and dump your old loan. To protect themselves, lenders tack on a prepayment fee. Finally, we have the weather swirling around the machine. This is the bond market's fear gauge. When traders can't predict where the global economy is headed next, they panic. And when they can't accurately price the risk, they tack on an extra safety fee, just to be safe. Joseph's sky-high mortgage quote has nothing to do with his credit score. It's the mathematical result of debt anxiety at the foundation, a toll for human behavior, and global market panic. Right now, that foundation is shaking. The U.S. government owes so much, it spends more paying interest on its debt than its entire military. Foreign buyers who reliably purchased that debt are spooked. To raise cash, countries like Japan are selling off their massive holdings of American bonds. When a major player floods the market with bonds, supply exceeds demand, forcing interest rates to spike. This creates a direct chain reaction. An emergency cash move in Tokyo instantly hikes rates for a family in Ohio, making their mortgage so expensive they cancel a kitchen renovation. But buyers aren't the only ones stuck. Meet Amy. During the pandemic, she locked in a mortgage rate below 3%. She is holding the financial equivalent of a winning lottery ticket. Amy recently got a job offer across town, but to take it, she has to give up her current loan. Looking at the math, moving to an identical house at today's rates means she would pay nearly twice as much every single month. So, Amy stays put. This is the lock-in effect. Tens of millions of homeowners are trapped by this exact math, which means the houses that would normally hit the market for people like Joseph simply aren't for sale. The bond market is squeezing Joseph from two sides at once. The machine made his loan wildly expensive, and it locked Amy in her house, making the supply of homes artificially scarce. If you are sitting there right now feeling like you did everything right and you still can't afford a home, drop the personal shame immediately. You are not failing. The math changed underneath you due to an invisible market you didn't vote for and can't control. If you are looking for a way forward, remember that while the price of a house is permanent, your interest rate is not. You can renegotiate your loan for a cheaper rate the moment the market cools down, but you can never go back and negotiate a lower purchase price. Financial freedom is the real price, and no property title is worth losing it. Sometimes the most powerful move you can make after seeing how this machine is rigged is to simply walk away until the odds turn back in your favor.